This is the video for the bank reconciliation example in Chapter 8. Alright, so on May 3rd, Reber Company has a cash balance per books of $6,781.50, and the bank statement from the bank on the same date has a balance of $6,404.60, so they want you to prepare a bank reconciliation. So here's our bank reconciliation. This is the basic format. So you're going to have a section for the bank. So the section for the bank is here. Then you're going to have a section for the books, and the section for the books is here. So the section for the books will have journal entries or adjusting entries for it. There's no adjusting entries for the bank section. So the balance for the bank statement will be recorded here, and the balance per your book, so this will be coming from your trial balance, will be reported here. So you need to make sure you get the right one. You also need to have this heading here. This is always the 2 points, just like it is on an income statement or a balance sheet or a statement of owner's equity. All right, so the first piece of information they give us on this is that the statement, so this would be the bank statement, includes a debit memo for $40, and that is for the printing of additional company checks. So the debit memo is from the bank's perspective. Remember, when the bank has the money, it's the company's money, the company you works for money. So to the bank, this is a liability. So if the bank has it on the books, so the bank has ABC's company, ABC's money, to the bank, this is a liability. So if the bank is recording a debit memo, what they're doing is they're reducing the amount of money they owe to you. So a debit memo from the bank means that they are reducing the value of the cash that you have. Okay, so this is the company's cash, as from the bank's perspective, is a liability. So a debit memo from the bank is reducing the amount of cash that you have. So when you see this, you have an expense for the checks being printed and the cash is being reduced. So when this gets recorded in the books section, so remember your journal entries are always in the books section, we're doing a check printing charge for $40, and this needs to reduce the balance of cash that the company has. So our second transaction, there were cash sales of $836.15 were deposited in the bank. The cash receipts, journal entry, and the deposit slips were incorrectly made. So the bank correctly recorded $836.15. So these were sales. So the entry was recorded on the books as a debit to cash and a credit to sales revenue. However, they're saying the cash receipts journal entry and the deposit slip were written out for $886.15, which means that the book entry was for $50 too much. Okay, so this is too much. So the cash on the books must go down. Okay, so what we see is that the cash has to go down, and the sales revenue also is going to have to go down. So when we show this here, it's that the cash balance needs to go down, so we need to do a subtraction for this. The next one, it tells us we have outstanding checks for $576.25 and deposits in transit. So those are both adjustments for the bank. Adjustments to the bank. Okay, so those are the two things that we always need to set up on the bank side. So the deposit and transits, those are going to be additions to the bank balance. Outstanding checks are going to be subtractions to the bank balance. So those are we're just going to put in here. So we've got our additions and our subtractions. The next piece of information, they tell us on May 18th, the company issued check number 118 for $685 to Linda Carson on account. So this is a check that the company wrote. So if it's a check the company wrote, that means cash gets a credit. And it was on account, so it's got to be accounts payable. So accounts payable has the debit, cash has the credit. That when it was recorded, it was incorrectly journalized and posted by Reber, who is the company you work for $658. So $685 is correct, $658 is incorrect. So the error is for 27. So they're saying that $685 is the correct amount of cash, and what was recorded was $658. So since we're crediting cash, the cash amount was credited for too little. So cash needs to go down. So if cash needs to go down, it needs a credit. So that's what we're doing here is accounts payable with cash with a credit. So here's the check with an error in recording. If it's a credit, that means the cash balance is going down. The next one, we have a note receivable that was collected by the bank. In addition to the note, there's interest, and then there's a fee being paid. So the net amount we're going to get is $3,060. So the adjusting entry that we would have is that cash has an increase. Okay, so cash is going to go up. Okay, so we need an addition to cash. So cash goes up by $3,060. This fee of $20, we can just put that into a miscellaneous. We have a note receivable, and it says the interest was not accrued. Okay, so since the interest was not accrued, we're going to record revenue. If it had been accrued, there would have been an interest receivable. So this will be an addition because the cash balance needs to increase. So cash is going up, so we're going to add it. Included with the canceled check was a check issued by Steiner to Ted Kress for $800. So this was incorrectly charged to us by the bank. So this is a bank error. So we didn't do anything wrong. The bank did it. So there's no adjustment on our side, but there is an adjustment on the bank side. So the bank took money out that should not have been taken out. So that needs to be added back to our balance, and the bank needs to correct it. So there will have to be a phone call made to the bank, and the bank is going to have to fix their information. Next piece of information. Bank statement shows an NSF check. Okay, so it's for $680. It was a check issued by a customer to us on account. So basically, this is a check that we received. It was a payment against accounts receivable. So cash went up and accounts receivable went down. So cash went up and accounts receivable went down originally. So we're basically reversing this. So this would go the reverse. And that's what we're doing here is cash is going down and accounts receivable is going to be re-increased. So cash needs to go down. So that's a subtraction. So cash is going down. That's the 680. And that's now recorded. So those were the journal entries. As each one was dealt with, the journal entry was written up and then it was put onto here. So these two are combined to give us this total. This is carried over. So this plus this minus this gives us this total. We've got this plus 3060. When we add these together, it's subtracting this. So this plus 3060 minus 797 gives us 9,044.50. These two numbers should be equal. And so we've proven that the bank adjusted bank balance is equal to the adjusted book balance, and that's what we're trying to do here.